The importance of life insurance. Life insurance is a critically important topic, not just for the potential financial windfall, but primarily because it provides peace of mind for both the insured and their family. The purpose of life insurance is to cover needs that a family will face if the insured passes away, such as debts, income loss, or continuing expenses. The payout isn't intended to make the family suddenly wealthy. Instead, it ensures the surviving family doesn't have to worry about paying for the mortgage, utilities, or other bills, allowing them the necessary time to grieve without financial stress. Money can be a deeply emotionally charged topic, and life insurance helps to ensure that people can prioritize their feelings and grief over financial concerns. Key life insurance terms. The adjusted cost base, ACB, is the buying price of an asset or the total amount someone has invested into it. This is the capital component of an investment. Key fact to remember is that the ACB is always tax-free. For example, if a business is bought for a price, that amount will be received tax-free upon sale before any taxes on profit are calculated. The fair market value, FMV, is the selling price of an asset. When people pass away and assets like businesses, households, or cars are sold, they are sold at their fair market value. Taxes generally come into play on the difference between the ACB, buying price, and the FMV, selling price, which represents the profit or growth portion. The cash surrender value, CSV, applies to permanent-based insurances like universal life, UL, and whole life policies. It represents the cash value or the amount of money in the investment portion of the insurance policy, net of any surrender charges. Surrender charges apply in the first 10 years of owning a whole life or universal life policy, meaning the policyholder cannot access all the invested money during that time. These charges are highest in the first year and gradually decrease until the 10th year, after which there are no surrender charges and the policyholder has access to all the money. If the cash surrender value is given, it's assumed that surrender charges have already been calculated. Taxation at death. Two primary situations are typically ignored when calculating taxes at death. Spousal rollover. Investments, usually RSPs, RIFs, TFSAs, and other registered investments, will roll over tax-free from the deceased spouse to their surviving legal or common law spouse. Taxes are only paid when the surviving spouse eventually withdraws the money. When a client with a spouse passes away, their investments are ignored in the immediate taxes at death calculation. Primary residence. The client's primary residence, also called principal residence, is also not taxed when they pass away. However, any rental properties or cabins owned will get taxed. For the purpose of the exam, the primary or principal residence should be ignored in the taxes at death conversation. Types of life insurance. Term insurance, or term life insurance, provides coverage for a specific amount of time, typically 10, 20, or 30 years. The price remains the same for the duration of the term. Once the term is over, the policy ends and premium payments stop. There are a few variations of term insurance. A renewable term insurance policy can be renewed for another term at the end of the existing term. For example, another 10 years. Renewal happens without any medical questions. However, because the insurance company is taking on more risk regardless of the person's current health, the price will increase substantially, often 3 to 5 times the original price. A convertible term insurance policy allows the term policy to be converted to a permanent plan, such as whole life or universal life. Conversion can happen at any point during the term and is done without a medical exam. Since converting to a permanent plan provides much longer coverage, the monthly premiums will increase. A client can purchase a policy that is renewable and convertible, or one that is non-renewable and non-convertible. Generally, anytime coverage is worse or has less features, it is cheaper per month. The keywords in an exam question that should lead to choosing a term-based product are timeframe needs or needs that have a clear start and end point. These include debts, mortgages, spousal support, or children's education. If a question asks what type of insurance is needed for these items, the answer should contain term. The term should be at least as long as the need, for example, a 20-year term for a 15-year mortgage, but not a 10-year term. Importantly, permanent insurance does not cover term needs in this course. Layering your coverage or insurance means combining different policies. For example, a client with a 20-year mortgage of $250,000 and spousal support of $100,000 for 10 years could buy a $250,000 term 20 policy for the mortgage and add the $100,000 term 10 as a rider or add-on. Riders are add-ons or customizations to the coverage and, as such, cost a little extra money. They must be added at the start of the policy and cannot be added years later. Bundling policies together can sometimes be cheaper because the client only pays one administrative cost instead of two. It is also simpler for the client to manage one policy and one monthly payment. The longest term or permanent insurance must always be the base policy, with shorter terms added as riders on top. A permanent insurance policy can have term riders, but a term policy won't have a permanent rider. Term to 100 T100 is its own product, which is a term policy that lasts until age 100. The premium price remains the same throughout the policy. If the policyholder dies before age 100, the policy pays out and payments stop. If the policyholder lives past age 100, they stop paying the premium, but the coverage continues until they pass away. T100 policies have no investment component. The entire premium goes toward the insurance cost. Permanent insurances. Whole life insurance covers the insured for their whole life. It has both an insurance side and an investment side. Whole life is characterized by its rigid design. The monthly premium is unchanging. For example, a $130 monthly premium might consist of a $40 insurance cost and $90 for the investment component. And these amounts won't change even if the client wishes to put in more or less money. Participating versus non-participating. The investment options in whole life are determined by whether the client picks a non-participating or participating par policy. In a non-participating policy, the investment portion of the premium does not get invested or grow by any percentage. This option is cheaper than participating. In a participating par policy, the investment portion does get invested and grow. The insurance company, not the client, chooses where the money is invested, typically in things like real estate. If the profits from these investments outweigh the expenses, for example, rent exceeding expenses, the insurance company gives a kickback or dividend to the policyholder. Whole life policies never decrease in value. They only go up when they profit, generating a dividend or kickback. Dividend options. If a client chooses a participating policy and a dividend is generated, they can choose how to receive it. Cash. Dividend. The client receives the profit directly as cash. Accumulation. The profit is reinvested back into the policies. Cash value. Premium reduction. The profit is used to reduce the client's following year's premium payments. Paid up addition, PUA. The profit is used to buy extra, added on permanent insurance for the client, with all the premiums for that new amount paid upfront by the investment growth. This effectively increases the policy's total death benefit at no extra monthly cost. PUA is the option to choose if the client wants their insurance to go up over time or keep up with inflation. While the premium payment remains rigid, the dividend option can be changed at any time, for example, from PUA to premium reduction. Whole life features and riders. The automatic premium loan, APL, is a built-in feature in all whole life plans. If a policyholder stops paying, the policy creates a loan in the background against the policy's cash surrender value. The loan accrues interest and must be paid off. If the loan catches up to the cash value, the insurance company will ask for more money or the policy will terminate. A waiver of premium, WP, rider is an add-on that pays the entire premium, insurance cost, and investment if the policyholder becomes disabled after purchasing the policy. If the client never returns to work, the premium continues to be paid for life. This rider is a good fit for clients who are worried about being unable to pay their premiums if they become disabled. The Guaranteed Insurability Benefit, GIB, rider is an add-on that allows the policyholder to buy extra insurance at specified future dates without needing to prove their health again. Buying more coverage will increase the monthly payment. This is a good option for clients who want to ensure they can increase their coverage in the future regardless of their health. Whole life versus universal life decision. The insurance column is more important in whole life. When deciding between whole life and universal life, the client's priority is key. If the priority is having the insurance for life, you should pick whole life. If the priority is growing their investments, you should pick universal life. Keywords that indicate a need for permanent insurance and most often whole life are funeral expenses, taxes at death, or charity donations. If a question mentions both term needs, like mortgages/debts, and permanent needs, the client needs a combination of term and permanent insurance. Permanent insurances. Universal life, UL, also has both an insurance and an investment side, but it is defined by its flexible features. Universal life's key features include the monthly premium is flexible. The client can put in more or less money, with the insurance cost remaining the same and the investment column changing accordingly. Unlike whole life, the client and advisor choose where the money gets invested. The cash value will fluctuate with the market, going up or down by interest/return percentages. Insurance cost options. The client must choose how the cost of insurance, COI, will be structured. Level cost of insurance, LCOI, this is also called ICOI. The insurance cost column stays the same for the life of the policy, for example. It stays at $40 a month forever. Yearly renewable term, YRT, this is also called annual renewable term, ART. The insurance cost changes every year, starting cheaper when the client is young and becoming more expensive as they get older. Insurance amount options. This option determines what the beneficiary receives upon the death of the insured. Face amount option. The beneficiary receives only the fixed face amount, the death benefit. The investment's cash value is included within this face amount. As the client's investment, cash surrender value, grows, the insurance company's liability, known as the net amount at risk, NAAR, decreases. This means that as the client's cash value increases, the cost of insurance goes down. The ultimate goal is for the client's cash value to equal the face amount, at which point the insurance cost becomes very small. This option is less expensive. Face amount plus account value option. The beneficiary receives the face amount plus the current cash surrender value, account value. The insurance company is on the hook for the full face amount. Because this option pays out more money, it is more expensive than the face amount option. Business owners often use this option because they can write off the insurance cost from their profits, making the higher cost less of a concern. A common setup for a universal life policy is combining the yearly renewable term, YRT, with the face amount option. The YRT allows the client to pay less money at the start to invest more, and the face amount option allows the client to slowly take over the insurance cost as their cash value grows, meaning they won't have to pay when the YRT price increases later in life. Universal life keywords. The keywords that should lead to choosing universal life are flexible premiums, being investment focused, or that the client is okay with more risk because the market can fluctuate. Calculations in permanent insurance. In permanent insurance policies, the total premium paid is split into the net cost of pure insurance, NCPI, and the adjusted cost base, ACB. The total premium paid is the total money put in to date. The net cost of pure insurance, NCPI, is the amount that has gone toward the insurance cost. The adjusted cost base, ACB, is the amount that has gone toward the investment side and is the tax-free portion. If the cash surrender value, CSV, the full cash value, is greater than the ACB, the difference is the taxable portion or growth. If the policy is canceled and the cash is taken out directly, this growth portion is fully taxed, not half-taxed like non-registered investments. The taxable number is the amount before it is multiplied by the client's tax rate. Policy loan and payout scenarios. If a permanent policy has an outstanding loan, including an APL, the loan and any accrued interest must always be paid off at cancellation or death. If the policyholder passes away, the beneficiary receives the face amount, example $500,000, minus the outstanding loan and any interest. If the policy was a face amount plus account value option, the cash surrender value is also added to the face amount before the loan is deducted. Cancellation. If the policy is canceled or surrendered, the policyholder receives the cash surrender value, example, $100,000, minus the outstanding loan and any interest. Determining amount of insurance needed. Scenario 1. Capital drawdown/assets minus liabilities. This method determines the amount of insurance needed to cover the client's debts. The calculation takes everything the client owns, assets at their fair market value, and subtracts everything they owe, liabilities. If the resulting number is negative, that amount is how much insurance the client needs to cover the shortfall. Scenario 2. Income replacement/capital retention. This method aims to buy enough insurance so that if the client passes away, their family can live off the investment earnings of the death benefit forever, replacing the client's income. For example, a $1 million policy earning 5% will generate $50,000 per year. If the question does not give you an actual number for taxes or inflation, even if it talks about them, the math is straightforward. The insurance needed is the yearly income divided by the interest rate. For example, a $60,000 income replacement divided by a 5% interest rate equals $1.2 million in insurance needed. If the question does give you a number for taxes or inflation, a three-step estimation method can be used as an alternative to the complex textbook formulas. Step 1. Calculate minimum value. Take the yearly income and multiply it by 30. This gives a minimum value. Any answer choices below this number should be eliminated. For example, 60,000 times 30 equals 1.8 million. Step 2. Calculate range. Take the yearly income and multiply it by 40. The correct answer will be within a 1 million range of this calculated number, example plus or minus 1 million. For example, 60,000 times 40 equals 2.4 million, so the range is from 1.4 million to 3.4 million. Step 3. Choose higher answer. If more than one answer choice falls within this range, pick the higher one. In the life insurance module, if one is struggling with the math, guessing high is generally the safer strategy. Final life insurance concepts. The temporary insurance agreement, TIA, provides a client with immediate insurance coverage while their application is being underwritten. To qualify for the TIA, the client must pay the first premium and answer certain health questions to confirm they are currently healthy. If they don't do both, they don't qualify for temporary insurance. The Medical Information Bureau, MIB, is a database that acts as the Carfax or credit score for a client's insurance history. It tracks what policies the client has, what they have been declined for, and what they have canceled. The MIB ensures the client is not trying to buy excessive amounts of insurance from multiple companies and verifies the truthfulness of their answers on the application.